Hello and welcome to ACCA Masters. Today we'll be covering Chapter 21 of F3, Consolidated Statement of Financial Position. Now, consolidation uh, is what we'll be covering in the next two chapters, 21 and 22. Consolidation is a very important topic. It's a new concept that is being introduced uh, for you uh, at the end of F3, and then this concept will continue on in F7 in more detail as well. But even for F3, because the concept is just being introduced, it is quite important. They do like to test this concept a lot, uh, because again it will come up in more detail in F7. So they like for the students to be well prepared for that. So they will be testing the basics of this concept in the F3 exam in quite some detail. You can roughly expect. I don't usually make predictions because it's the exam is generated at random by the software, so it's impossible to say exactly which questions will appear the most um, from which topics. But I think it's safe to say that from consolidation you can expect up to 10 to 20% of your exam. 10% very safely will be from consolidation. That is both your MCQs and your MTQs. One of the MTQs is likely to be on consolidation. Again, that can not be the case as well, but it's very likely that most of the students will get a consolidation MTQ in their exam. And then you may see some MCQs uh, from consolidation as well. So overall, it's quite an important topic, and even from a practical point of view, to to actually start with the concept and then give you an idea of why this is so important for practical reasons. Now consider an investment, right? Consider a business making an investment. Now we have different types of investments that a business, that an organization can make, right? First of all, we have a simple investment. Now this is an investment in the shares of another entity that is held for the accretion of wealth and is not an associate or a subsidiary. So a simple investment is when you have invested in the shares of another company, and of course, you will remember that shares give you ownership in a company. So, if, for example, let's say company A is buying some shares of, you know, company B, in this case, company A is now an investor in company B. Right? Company A is one of the investors, one of the owners of company B. So company A has ownership of company B. Now the question is, how much ownership does company A have? Let's say company A has bought enough shares of company B that they have 15% ownership of company B. Now this is what we call a simple investment. Any ownership percentage up to 19% will be considered a simple investment, right? So starting with 1%, 2%, any ownership percentage, any level of investment that gets you up to 19% ownership in another company, that is a simple investment. Now, this is a simple investment by company A into company B because this investment is only getting company A 15% of ownership of company B. So this is a simple investment, right? Now, You can see in the description it says that it's an investment that is not an associate or a subsidiary. Now, we'll discuss what associate and subsidiary level investments are. To sum up the concept of a simple investment, any investment that you make is a non current asset for you. Specifically, a simple investment which gets you between 1% and 19% ownership of a company is considered to be a non current asset and therefore will be recorded as a non current asset in the statement of financial position. Any dividends received from such a company, any return received from such a company will be recorded as income in the statement of profit and loss. So if you receive some income from company B, if company A receives some dividends from company B, this dividends will be recorded as income in the statement of profit and loss of company A, right? Because then for them it will be dividends received income. So this is a simple investment. Now, what if you were to buy enough shares of a company, right? What if you were to buy enough shares of another company where you were getting more than 19% ownership, right? So if let's say H group, right, that is a company or a group of companies, if they have between if this company has between 20% ownership or any percentage up to 49% of ownership in M group, in M company, you can say, then M group is an associate of H, right? So if H owns anywhere between 20% and 49% of M, then M is an associate of H, right? So in this case, for example, if H owns, let's say, 35% of M, then you can say that M is an associate of H. Now, why are we defining this? We're defining this because we need to record this a bit differently from how we record a simple investment. There's a slight difference. There's something called equity accounting that we have to do for associates. We'll look at this uh, in a bit more detail at F7 level. It may come up here as well slightly, uh, but it'll be a simple adjustment that you have to, because at this level, at F3 level, we'll be covering very basic consolidation. And it's really at F7 level that you start to see the details and the more advanced concepts. We'll have some slightly advanced concepts here as well, but not as much. So if each company owns anywhere between 20% and 49% of M, then M is said to be an associate of H. This means that H will have significant influence on M, right? Because if H has anywhere between 20% and 49% of M, then they are able to exercise significant influence over the decisions of M. Obviously, it does not mean that H has full control of M. H is not the only decision maker. M will have other owners as well, which will be involved in the decision making process when it comes to M. But H will have significant influence. Significant influence basically means that you have quite a bit of input. You're able to give quite a bit of input when it comes to the decision making of M. right? Any decision making related to M, H will be able to, you know, give quite a bit of input into that because they have 20%, for example, ownership. So they basically have 20% of the voting rights. Or if they have 25% ownership, they have 25% of the voting rights. So that gives them quite a bit of hold, quite a bit of, power when it comes to deciding about M and how their business will proceed. Now, if H has 50% or higher ownership of M, then M is a subsidiary, right? So that's uh, the level of investment you're making above that you're making an associate, where you're able to get 50% or even more ownership of the investee, of the company that you're investing in, right? So if H makes such a level of investment that they're able to get, if they buy enough shares that they have 50% or more shares, more ownership of M, then then M is said to be a subsidiary of H. Right? Now, in this case, H will have full control of M, right, and can take any decision regarding uh, M and their business operations, and no one has enough authority or power to oppose this decision. Because if you have 50% ownership, now remember, ownership usually represents your voting rights as well, right? The how many shares you own also represents your voting rights. So if you own 50% or more shares, which means you have 50% or more ownership, it means you have 50% or more voting rights of the company. So in this case, H has 50% or more voting rights of M. So basically, whatever decision is to be taken, you usually vote on that. Shareholders will vote on, w- you know, what they want to be done with the decision. For example, if it's the start of a new product, if it's the launch of a new product, shareholders can vote on if they want to, you know, if they want the product to be launched or not. So in that case, each will have the final decision because they have 50% or more ownership. Let's say they have 55% ownership of M. So they have 55% of the votes. So it doesn't matter what anyone else votes. If the rest of the shareholders, if the rest of the owners, even if they all vote the same thing, let's say all of the rest of the shareholders, which is 45%, they vote for the product to not be launched. Right? They vote no for the product launch. And H H company alone votes for the product to be launched. In that case, the product will be launched, right? Because more than 50% of the votes for the decision are for yes, for the product to be launched. And all those votes have come from H. So, because they alone have the majority shareholding, they alone have the majority of shares, they can take any decision they want to when it comes to M, and no one has enough power, even the rest of all of the rest of the owners of the company of M don't have enough power collectively to oppose the decision that H is siding with, that H is going for, because they alone have the majority shareholding, they alone have the majority ownership. So this means that H has full control of M and can take any decision regarding M, and no one has enough authority to oppose this decision. So overall, you can have three types of investments then. If you have, if you're making between one and, well, not zero, but you can have 0 point something investment. So between 0. one, let's say, and 19% investment, that is called a simple investment. It is recorded as a non-current asset in the statement of financial position, and any returns from this is recorded as income in the statement of profit and loss. Then you can have between 20% and 49% ownership of a company. In this case, you the investee is basically an associate of yours. So in this case, M is will be an associate of H if H has between 20 and 49% ownership of M. In this case, uh, H, the investor, is said to have significant influence over investee. Investor is the company investing, and investee is the company that money is being invested into. So in case of an associate where the investee is an associate, the investor is said to have significant influence over investee. And then any ownership percentage, at 50% or above, in this case the investee is called a subsidiary of the investor. And in this case, the investor is said to have full control of the investee, right? So those are the three levels of investments, their names, and how much power you have in each of these cases, in each of these scenarios. Now, we will mainly be focusing on the recording that you have to do in case of a subsidiary, right? If you invest enough money into another company that it becomes a subsidiary of yours, if you buy enough shares, more than 50% shares of another company, so that it becomes a subsidiary of yours, how do you record that investment, that level of investment in your accounts? In that case, you cannot just record that investment as a non current asset in your accounts. You have to carry out what is called consolidation. So in this case, the company that is investing is known as the parent, and the company that is being invested into is known as the subsidiary, right? And parent, obviously, because they have the majority ownership of subsidiary, they have 50% or more ownership of subsidiary. The parent is said to have control of subsidiary. So in this case, we have to consolidate their financial statements. Now, what does consolidation mean? What do we mean by we have to consolidate their financial statements, the financial statements of the parent and of the subsidiary, the investor and the investee? This is only done in case of subsidiary, right? The parent is an entity that has control over another entity, over subsidiary. So in this case, parent is the investing company, the company that is buying the shares, and the subsidiary will be the investee company, the company that is being bought by the parent, the shares of which are being bought by the parent. So subsidiary is an entity that is controlled by another entity that is controlled by the parent. And control is the power to govern. This is the official definition of control as given in the accounting standards. The power to govern the financial and operating policies of an entity so as to obtain benefits from its activities. So, control basically means you can do anything with the subsidiary. You can take any decisions regarding the financial or operative decisions, operating decisions of the company, of the subsidiary, and no one again has enough power to oppose you. So the parent can take, basically they can take all the financial, all the operational decisions of the subsidiary, and no one can oppose the parent in this case. So consolidation means putting the statements together. Consolidating the statements mean putting the statements together, which means basically combining the statements. So what we have to do in such a case, where one company, where the parent company, right, let's say company A, which will be known as the parent company, owns 50% or more shares of another company, let's say company B, which will then be called the subsidiary company. In such a scenario, company A have to consolidate their financial statements with company B, which means that A's financial statements will be presented together with company's B financial statements. So we will present one statement of profit and loss. So, for example, one statement of profit and loss will be made, and the revenue included in this statement will be the sum of the revenues of parent and subsidiary. And the expenses included will be the sum of expenses of again both parent and subsidiary. And the same thing will be done for all financial statements. So, this statement will be called consolidated statement of profit and loss. So, the consolidated statement of profit and loss is basically the statement of profit and loss of company A and company B presented together as one company. We're presenting the income and the expenses of these two companies in one statement as if they are one company, as if they are a single company. And that is a consolidated statement of profit and loss. And we'll do the same thing with the statement of financial position as well. We'll present the data of company A, we'll present the statement of financial position of company A and company B together as if these two are a single company. And we'll call that statement the consolidated statement of financial position. IFRS 10 is the accounting standard that provides you the guidelines. There are other accounting standards as well that give you guidelines on consolidation. IFRS 10 being the main standard covering the preparation of consolidated financial statements. So let's say we have a scenario here, right? Daniel acquired 80% of the ordinary share capital of Craig on 31st December 2016 for $78,000. Now, this is how they usually present the information to you. They're basically telling you that Daniel is an investor, and the investor company is buying 80% of the ordinary share capital. Ordinary share capital, remember, represents ownership in a company. So if Daniel is buying 80% ordinary shares of Craig, that Daniel has majority shareholding, majority ownership of Craig. Daniel now has control of Craig, and therefore Daniel will be known as the parent, and Craig will now be known as a subsidiary of Daniel. Right? And this purchase took place on 31st December 2016 for 78,000. So obviously when you're buying shares of a company you have to pay some money. Daniel has bought the shares of Craig for $78,000. This is known as the consideration paid in this case. Daniel has paid $78,000 of consideration to buy 80% ownership in Craig. Again, these are companies, not people. So Daniel is the parent and Craig is the subsidiary. And Daniel owns 80% of Craig from 31st December 2016 onwards, right? So this is how you can present this data. This is known as the group structure, right? And that is the first thing you need to define. This these two companies are now known as a single group. Daniel and Craig are now known as a group. The group, excuse the line, the Daniel is the parent, Craig is the subsidiary, and these companies together are now known as a group, right? And the group is always named on the name of the parent. So we can call this the Daniel group of companies. We can call this the Daniel Group or the Daniel Group of companies. So this is now a single group, and that is what you need to start with. You need to start with defining the group structure. You need to start with defining who is the parent, that will come here at the top. Then you make a connection here with the subsidiary, and then you define along with that the ownership percentage of the parent in subsidiary, and when this group came into being, when at what date the parent bought enough shares in subsidiary to become a parent. So you need to write down the date and the ownership percentage as well. We'll use these in our calculation later on. So you start with defining the group structure, and this is your first working that you'll have to perform for a consolidation scenario. Obviously, we're assuming this is a full-fledged consolidation scenario. You can have to perform one of these calculations that we'll be covering now. There are total five workings that you need to be familiar with when it comes to consolidation. We'll cover all of them today, and then you need to be familiar with all of them. You need to clearly understand the reason for performing all these calculations, because they can give you an MCQ where they just ask you to perform calculation 3, working 3. So you need to be very clear on why we're performing that working. Obviously, we'll be covering the concepts for each of these working. So we're done the first one, group structure working. The second working is for the net assets calculation. Now, we basically have the acquisition date here, right? That was 31st December 2016. That is when Daniel became a parent of subsidiary of Craig, its subsidiary. At this date, the fair value of the net assets of Craig were 85,000. Right? So they will always give you, either they will give you the total value of net assets of Craig, right? As they have done here, right? The fair value of net assets of Craig, or they will give you a breakdown of the net assets of Craig. Now, we have to calculate the total net assets of Craig at the date of acquisition, and then at the reporting date as well, right? Basically, the acquisition took place on 31st December 2016, right? It's very likely that today will be a different date. The day that we're doing these calculations on, the latest accounting year, and you can say it's likely to be 1 year ahead. It's likely to be 31st December 2017, right? So basically, this is your reporting date. This is the date that you're now preparing the statements on, right? So what you have to do is perform a bit of calculation to find out how much profit the subsidiary has made ever since it has been acquired by the parent. Ever since Craig has been acquired by Daniel, how much profit has Craig made after the acquisition date now till the reporting date, right? Remember, the acquisition took place on 31st December. Daniel bought Craig on, or 80% of Craig, on 31st December 2016. So that was the acquisition date. So we need to define the acquisition date and now the reporting date, and we need to compare the net assets of the acquisition date with the net assets of the reporting date, and that will give us the profit that Craig has earned post acquisition, after acquisition. So we start with the net assets at acquisition date, and then we'll create the net assets. We'll write down the net assets at the reporting date. And we use the equity section of the subsidiary company for this. Right? They have given us the total value of net assets at acquisition already in this scenario. Sometimes they can do this, but you may have to calculate these yourself instead, and you will use the equity section of the subsidiary company, because remember, according to the accounting equation, net assets are equal to equity or capital. So basically, instead of taking the net assets in our calculation, instead of taking assets and then subtracting liabilities from those, We'll just take the equity section, the equity values directly, and it will give us the same net assets value that we would have gotten if we were taking the difference between our assets and liabilities. So we'll use the equity section to calculate the net assets of Craig first on the acquisition date and then on the reporting date. So firstly on the acquisition date, these values will be given in this scenario. So I'm assuming values here. Let's say the share capital of Craig on the acquisition date was 50,000. Now it's very likely that the share capital will stay the same on the reporting date as well. So you usually mention the same share capital on the reporting date as well, unless they tell you otherwise. Although that's not likely to be the case, the share capital and the share premium are likely to be the same on the acquisition date, and they're likely to stay the same till the reporting date of the subsidiary. So once you have put in these values, then obviously you'll be going through the equity section. So you will see all the items you need to include here. Uh, uh, Everything included in the equity section of the subsidiary you will include in this calculation. Um, Assuming very likely next we'll have retained earnings. So let's say the retained earnings of subsidiary at acquisition were 15,000 and at reporting date they are 20,000. All this information will be given in the scenario. Now, once you have all these values, assuming there are no other values, no revaluation surplus, for example, in the equity section of subsidiary, we will total the net assets at acquisition, which are 85,000, right, as given in the scenario as well. So, you see, in the scenario, they have given you the total net assets value here, ready made, but sometimes you may have to calculate the net assets value at acquisition like this using the equity section of the subsidiary. So the net assets of the subsidiary at acquisition were 85,000, and now at the reporting date the net assets of the subsidiary are, will add up all the equity values and we get 90,000. So what you do now is you take the difference between your net assets at the reporting date and your net assets at acquisition, and that will give you the change in net assets after the acquisition. This change in net assets is basically the profit after acquisition. This is how much profit the company has earned, the subsidiary has earned after getting acquired by the parent. Right? So once you calculate this profit after acquisition from the second working, you move on to the third working, that is for um, well, we move on to the third working. Before that, you need to be familiar with a concept called non-controlling interest. Right? Non-controlling interest arises when the parent entity controls a subsidiary but does not own 100%. So let's say if P owns 70% of the ordinary shares of S, there is an NCI of 30%. Right? So basically, it is the percentage of ownership not owned by the parent. So if the parent owns only 70% of its subsidiary, right? That's still a subsidiary. That's still a subsidiary level of investment. But P does not own the whole company. P only owns 70% of the subsidiary. So the other 30% is owned by other investors, right? And this percentage owned by other investors is known as NCI, non-controlling interest, right? This is the percentage of ownership owned by other investors, investors other than the parent. So in this case, for example, Daniel owns 80% of ordinary shares of Craig. So that means that other investors own 20% of ordinary shares of Craig. So NCI percentage is therefore 20%. Now they will also give you the fair value of NCI in such scenarios. You see, Daniel only paid for 80% of Craig. So Daniel, the 78,000 that Daniel paid for buying Craig, that is only for 80% of Craig's shares. So we need to know what the value of the other 20% shares is. Now they will tell you the fair value of NCI in the scenario. In this case, NCI is valued using the fair value method, and the fair value of NCI at acquisition was 19,000. So they have given us the fair value of NCI. at acquisition, that is 19,000, right? Now we basically need to calculate the goodwill of this business at the acquisition date, because you see 78,000 was paid by Daniel, consideration paid by Daniel to acquire 80% of the subsidiary, but the other 20% was not paid for by Daniel because Daniel only purchased 80% of the subsidiary. So the value of the other 20% is 19,000. And so the total value of this company in the market, the fair value of this company is 78,000 plus 19,000. And from this, you can subtract the net assets um, of the subsidiary. The net assets of subsidiary, you will also get them from working too, but they are given here in the scenario directly 85,000. So you subtract the net assets of the subsidiary at acquisition from the total value of the company, and you get the goodwill of the company. Goodwill again is the extra value of the company that the investor is willing to pay beyond the net assets value, right? So net assets of the company of subsidiary are worth 85,000. Otherwise, the subsidiary has a total value of 78,000 plus 19,000, so that is about 97,000. So this subsidiary has a total value of 97,000 in the market. Investors are willing to pay 97,000 for this asset, for this subsidiary, for this company, but the net assets of the company are only worth 85,000. So the extra value that investors are willing to pay for this company, the 12,000, that is goodwill, right? That is the good image that the company has generated. That is the positive brand image that the company has generated over the years, that the investors will now be able to benefit from. So this 12,000 of goodwill, this is what you calculate in the third calculation. Again, you take the consideration paid by the parent, you take the fair value of NCI, and from these you subtract the net assets of subsidiary at acquisition. Again, it may be given in the scenario, or you may be able to get this value from working to, from the first column of working to, net assets at acquisition, this column, right? So you can get the value from here, or it may be given in the scenario, again depending on what kind of, how detailed the question is. So you subtract the net assets of the subsidiary at acquisition from the fair value of consideration paid and non-controlling interest, and you get the goodwill value of your subsidiary. Now, after this, you can go to working for, which is where you total the value of NCI at the reporting date. Now, the value of NCI at the acquisition date was 19,000 as given in the scenario. The NCI at acquisition date was 19,000. Now, in this, you add the share of profit that is supposed to go to NCI, to the non controlling interest, right? So, the post acquisition profit that we have calculated in working two, it will be divided between the parent and the NCI. 20% of that profit, 5,000 was the post acquisition profit as we calculated in working two. 20% of this profit is supposed to go to NCI since they own 20% of the of Craig. So 1,000 will be added to the value of NCI at acquisition, and this will give us the value of NCI now at the reporting date, which is 20,000. And then in working 5, we can calculate the group retained earnings, which is basically the parents retained earnings, right? And for that, we'll start with the parents retained earnings, which again will be given in the scenario. They're not mentioned here, so we can assume that parents retained earnings were 40,000. And in this, we'll add parents share of post acquisition profit, which will be the post acquisition profit calculated in working two, multiplied with parents ownership percentage. So to 80% of $5,000 of post acquisition profit will go to the parent, will go to Daniel. So that will be added in parents retained earnings, Daniel's retained earnings. And so we will get the group retained earnings at the reporting date, that is 44,000. Right now, once you have the 5 workings done, You have enough values to prepare the consolidated statement of financial position. Here we have another scenario. You can perform the five workings for this scenario, and then I'll show you how to prepare the financial statement, the statement of financial position specifically for this scenario. This is what a full-fledged question will look like. In this case, H is the parent, S is the subsidiary. You can pause the lecture here if you want and perform the five workings. I'll be explaining now how to figure out the answers, the workings. H is the parent here, right? S is the subsidiary as given in the description here. And H has bought, H has acquired 100% holding in S on 1st January 2018. And at that date, S's retained earnings, subsidiaries retained earnings were 15,000. Right, so they've given us enough information to perform the five workings. First of all, we'll create the group structure. H is the parent, S is the subsidiary. H owns 100% of S, and it was the purchase was made on 1st January 2018. Then we'll have the net assets working. We will first compile the net assets at acquisition using subsidiaries. Remember, we have to use subsidiaries equity section to perform this calculation. Now they have given us the the acquisition took place on 1st January, that is the acquisition date, and then we have the values for equity on the reporting date, that is 31st December 2018. Now, if they give you the values for the reporting date, you can see that they have mentioned here subsidiaries retained earnings. They were 15,000 on 1st January 2018 on the acquisition date, right? You can assume that the ordinary share capital of subsidiary and the share premium of subsidiary was the same on the acquisition date as it is here on the reporting date. So, for the share capital and the share premium of subsidiary, you can assume that the values are the same on the acquisition date as they are now given at the reporting date. The retained earnings for subsidiary they have given for the acquisition date at that date, which is 1st January 2018, the acquisition date, the retained earnings were 15,000. Now, at the reporting date, we can see that the retained earnings of the subsidiary are 25,000. So we'll put 25,000 in front of retained earnings in the reporting date column. And that gives us the total net assets at acquisition and at reporting date. We can take their difference to calculate the post acquisition profit, that is 10,000. So if they give you the reporting date values for subsidiaries equity section, you can assume that the share capital and share premium have not changed since the acquisition date, and therefore they'll be the same for acquisition and reporting date. The retained earnings you can get from the for the reporting date you can get it from the statement, and for the acquisition date retained earnings they're likely to give you those in the additional information as they've given it. Now once you have the post acquisition profit, you can then move on to working 3, that is the working for goodwill. Now in this we start with the consideration paid, right? The consideration paid can be found from the individual statement of the parent. Now this here is the individual statement of the parent of H, and you can see that in this individual statement we have the investment mentioned, shares bought in S of $60,000. Right now this is how much H has paid for investment in the subsidiary, for shares of subsidiary. So that is the consideration paid. This obviously will not be mentioned in the consolidated statements, but it will be mentioned in the individual statements of the parent. So we have the consideration paid of 60,000. There is no NCI here, so there is no fair value of NCI, that is 0. So from this we have to now subtract the net assets of the subsidiary at acquisition, which as we calculated in working 2 were 45,000. So we'll subtract the net assets of the subsidiary at acquisition of 45,000 from the consideration and the fair value of NCI, which is 0 in any case. We get the goodwill amount of this subsidiary, that is 15,000. Now, for working 4, there is nothing to be done since there is no NCI, so we'll move directly on to working 5. That is group retained earnings, and in this we start with parents retained earnings. We'll go to parents statement of financial position, and there we can see parents retained earnings of 70,000. We'll start the calculation with this, And in this, we have to add parents' share of post acquisition profit. Now, the post acquisition profit was 10,000, and all of that is supposed to go to the parent since H owns 100% of S. So, the full 10,000 amount will be added in parents' retained earnings to get our group retained earnings amount. Now, once we're done with these five calculations, we have the goodwill amount, the NCI amount is obviously zero, and the group retained earnings amount from working five. We can now start preparing the consolidated statement of financial position. For the assets um section and the liability section, there is a simple rule. You just have to add up the assets of parent with the assets of subsidiary. So basically, for the non-current assets, we can see that the property, plant, and equipment of parent is 85,000, whereas the property, plant, and equipment of subsidiary is 18,000. We add these two up. We add these two up, and we get the total property, plant, and equipment for the two companies, right? We're preparing the consolidated statement of financial position or the group statement of financial position of each group. Remember, I said the name of the group will be based on the name of the parent. So we add up the total assets of the parent and the subsidiary, and we get our property, plant, and equipment for the group statement of financial position, that is 103,000. Right. We will also mention the goodwill that we have calculated in working 3 in our statement of financial position. The goodwill on acquisition given in working 3 was 15,000 as we calculated it. This is also a non-current asset and it will be included in the non-current assets of the consolidated statement as well. Now, the investment amount as mentioned in the statement of the parent will not be included in the consolidated financial statements since that is not something that we can mention in the consolidated financial statements. It's not something that makes sense to mention in the consolidated financial statement because remember, we're assuming at this point in the consolidated statements that these two are the same company, the parent and the subsidiary. So you cannot say that you have made an investment in your own self. So because with the group statement we're assuming that H and S are the same company, we cannot make we cannot put 60,000 in there because that's investment made by H into S. So it doesn't make sense to say that you've invested in your own self, and therefore we cannot put this investment amount in the consolidated financial statements, in the consolidated statement of financial position. Instead, we put goodwill here, right? So that sums up our non-current asset section. And then with the current asset section, we'll do a similar thing. Add up the current assets of the parent with the current assets of the subsidiary to get the total current assets to be put in the statement of financial position, consolidated statement of financial position. Now we can add the non-current assets and the current assets to get our total assets. So the format is the same. The rule is very simple. We just add the non-current assets up where possible. Goodwill is an extra thing you have to show in the non-current assets that we calculate earlier in working 3. An investment made in the subsidiary that will be mentioned in parents statement of financial position, you have to ignore that. So once you have the total assets, now we move on to the equity section. Now the adding rule does not apply to the equity section. For the equity section, we will only take the values of the parent's equity section. So we'll take the parent's equity share capital of 65,000. We'll take parent's share premium of 35,000, right? And then for the retained earnings, we will use the value that we have calculated in working 5. The group retained earnings of 80,000 will be presented here as well, right? And that will give us the total equity section amount. And then for the liability section, we'll use the same rule again. For the non-current liabilities and the current liabilities, we'll add up the values of the parent and the subsidiary. In this case, we only have current liabilities of 135,000 for the parent and 47,000 for the subsidiary. We'll add these up and we'll get the total current liabilities for the consolidated statement of financial position. Now, once we have calculated these, we can total the liabilities as well along with the equity, and they should still be equal to the total of our assets. So the same format is used for assets and liabilities section. It's a simple rule of just adding up the assets and liabilities of the parent. You have to ignore the investment mentioned in the parent statements. Don't include that in the consolidated statement of financial position. Goodwill gets added to the non-current asset section. That's an extra value. The for the equity section, you're only supposed to take parents values, equity values, and for the retained earnings value, you will take the value of calculated in working 5. If there was NCI in this scenario, that will also be mentioned in the equity section of this consolidated statement of financial position. Other than that, this pretty much covers a basic consolidated statement of financial position. Here's another scenario. You can pause the video here, the lecture here, and attempt it yourself. You're supposed to create the 5 workings and then the statement of financial position for D and J. So I'll be showing the answer now. First of all, we have the group structure, 80% ownership, bought on 1st January 2018. Then we have the second working, the net assets working. We'll start with the share capital of the parent stays the same on the acquisition and reporting date. Then the share premium, sorry, of the subsidiary, not of the parent. This is always for the subsidiary. We start with the share capital of the subsidiary, then the share premium, the same on the acquisition and the reporting date. Then we have the retained earnings. The retained earnings are 20,000 on the acquisition date as given in additional information. On the reporting date, they're mentioned in the statement here, they're 25,000. We'll put that in the reporting column. Then we can total the net assets and we get the difference between our net assets at acquisition and at the reporting date. We can calculate the difference to get our profit after acquisition. Now, once we have the profit after acquisition, we can calculate goodwill in working 3. For the goodwill calculation, we'll start with consideration that is given here in the scenario, uh, actually given in the statement of financial position of the parent, that is 60,000. Now, once we have the consideration paid, we can add the fair value of NCI. We do have some NCI in this scenario. The fair value of NCI is 12,500. We add that in the consideration paid, and then from that we can subtract the net assets of the parent of the subsidiary at acquisition. The net assets of subsidiary as calculated in working 2 were 50,000 at acquisition. We'll subtract these and we get the goodwill of the subsidiary at acquisition. Then working 4 is for NCI. We'll start with the fair value of NCI at acquisition, and then we'll add NCI's share of post acquisition profit uh, of 1000 to get the NCI value at reporting date. We'll do the group retained earnings calculation. Then we'll start with the parents retained earnings of 70,000, and then in that we'll add parent share of post acquisition profit, that is 80% of 5,000, that is 4,000. So 4,000 gets added to parents retained earnings to get your group retained earnings. Now once we have all 5 values, we can prepare the statement of financial position. Now, the concept of goodwill is the difference between the market value of a subsidiary and the total value of its assets and liabilities. Goodwill is treated as an intangible non-current asset, as we've discussed already. Now, goodwill should be tested annually for impairment because you need to check if the subsidiary has lost some of its goodwill, some of its good reputation. If goodwill is negative, it should be treated as income in the statement of profit and loss. Sometimes you'll pay uh, less than what the net assets of the subsidiary are worth. So if that is the case, you'll treat the negative goodwill, again you'll just get a negative value in your goodwill calculation in working 3. You'll treat that negative goodwill as income in the statement of profit and loss, in the consolidated statement of profit and loss. And then we have the concept of fair values. We'll continue with this concept and the rest of the adjustments in the next lecture. Do let us know if you have any questions so far. Feel free to attempt the questions that we've tried today. Let us know if you face any issues with those. I'll assign some kit questions once we're done with the chapter. Um, we have done the basic preparation of the consolidated statement of financial position. So again, do try the workings repeatedly. From this point on, everything that we do is additional to this main concept, to this basic framework that we've looked at today. So do try this as much as you can, and again we'll continue with some additional adjustments that you have to make in these workings in the next lecture. We'll see you then. Take care. Bye bye.